A sloth, a donkey, and a curious human. Send a prompt and see what they're doing. One hits record with a question on his mind. Two brothers pick it up, see what they find. Corn takes his time, Herman's got the facts. Back and forth, they never hold back. My weird prompts, come on in, that's where we begin. My weird prompts, glad you're here.
This episode was generated using artificial intelligence. Please verify facts.
Have you ever had that feeling of total disbelief when you realize it is easier and faster to send a physical package across the country than it is to move digital numbers from one bank account to another? You hit send on a transfer Friday afternoon and the money just vanishes into a black hole for 3 days. It is March 8th, 2026. We are living in a world of instant communication, yet our financial plumbing still feels like it is running on steam engines and carrier pigeons. It is the classic T+2 frustration. Why does my money need a weekend at the beach before it shows up in your account?
Herman Poppleberry here, and Corn, you are hitting on one of my absolute favorite frustrations. Our housemate Daniel actually sent us a prompt about this very thing earlier today. He was asking why, if crypto can move value almost instantaneously across the globe, the conventional banking system is still stuck in this multi-day waiting room. It is a brilliant question because it forces us to look under the floorboards of the global economy. We are talking about the architectural friction that defines our modern lives.
It really does. And I think most people assume it is just laziness or old computers. Like, maybe the bank is still using a mainframe from 1975, and that is why my rent payment is pending. But the more I look into it, the more I realize that the friction is often by design, or at least it is a byproduct of a very specific type of architecture that prioritizes things other than pure speed. It is a paradox, right? We can stream a 4K movie from a server in Iceland instantly, but moving a few bytes representing $50 takes 48 hours.
We are talking about the difference between a system built on trust and reconciliation versus a system built on mathematical proof and broadcast. Today, we are going to tear down the walls of the legacy banking system, look at the literal plumbing like the clearinghouse interbank payment system in Fedwire, and then see what the traditional world is actually stealing from the crypto world to try and catch up. We are going to explore why instant is actually a lot harder than it looks when you have to account for every penny across thousands of different institutions.
I love that framing, because even if you are a crypto skeptic, you have to admit that the competition has lit a fire under the central banks. So let us start with the basic what. When I send money from my account at one bank to a friend at a different bank, what is actually happening in those 48 to 72 hours? Why does it not just update a database and call it a day?
The core issue, Corn, is that there is no single database. That is the fundamental aha moment. In the traditional banking world, every single bank maintains its own private ledger. When you send money, your bank records a debit on its ledger. But your bank does not have permission to write a credit on your friend's bank's ledger. They are two separate silos. They are like two people in different rooms writing in their own private diaries. If I write in my diary that I gave you $10, your diary does not magically update. We need a middleman, a trusted third party, to sit in the middle and say, okay, I see Bank A is down $50 and Bank B is up $50. I will settle the difference.
Right, and that middleman is usually the central bank or a massive clearinghouse. But even then, they do not do it one transaction at a time for most things, do they? That is where the batch processing comes in. I have heard this term a lot, but what does it actually mean for the plumbing?
This is where we get into the concept of netting. Imagine if you and I were out for the day. You buy me a coffee for $5. Then I buy you lunch for $15. Then you buy me a drink for $10. We could stop and exchange physical cash after every single purchase, but that is annoying and inefficient. It requires us to have the exact change ready every 10 minutes. Instead, at the end of the day, we sit down, look at the total, and realize I owe you $5 net. We settle once. That is how the automated clearinghouse, or ACH, works. It gathers thousands or millions of transactions, bundles them together, and settles the net difference between banks at specific times during the day.
So, the delay is essentially the bank waiting for the bus to fill up before it leaves the station. If I send my transfer at 5 p.m. on a Friday, the bus for that day has already left, and the next one does not depart until Monday morning. It is an efficiency play for the banks, but a massive inconvenience for the consumer. But why do they need the bus at all? Why not just drive 1,000 tiny cars?
Because those tiny cars are expensive. This is a liquidity play. By netting transactions, banks do not have to move as much real money around. If Bank A owes Bank B $1 billion, but Bank B owes Bank A 900 million, they only need to move 100 million to settle the score. This reduces the amount of capital they need to keep on hand just to cover transfers. If they settled every single transaction individually, they would need massive amounts of liquid cash sitting in their central bank accounts every second of the day. The slowness is actually a way to save money on the cost of capital.
But wait, we do have wire transfers, like Fedwire in the United States. Those are pretty much instant, or at least they happen within minutes. Why is every transaction not just a wire transfer? If the technology exists for the big guys, why am I stuck with the slow buzz from my $50 Venmo?
Because wires are gross settlement systems. In a wire transfer, every single transaction is settled individually and immediately. There is no netting. That is why wires cost $20 or $30 while ACH is often free. It requires much more active management of liquidity. If a bank sends $1 billion wire, that money is gone from their reserves instantly. They cannot wait for an incoming $1 billion wire to cancel it out. It is a high-stakes, high-cost way of moving money that the system generally reserves for big institutional moves or real estate closings. And even then, Fedwire has operating hours. It is not a 24/7 system. It sleeps on the weekends just like the bankers do.
So we have this two-tier system, the slow cheap lane and the fast expensive lane. But then you have the regulatory layer, which we've talked about before. Specifically back in episode 985, when we discussed the history of Know Your Customer and anti-money laundering laws. That adds a whole other level of stop and search to the plumbing, right? It is not just about the math, it is about the police.
Oh, absolutely. This is a huge part of the latency that people forget. Every time money moves, especially across borders, it has to pass through these compliance filters. The bank has to check, is this person on a sanctions list? Is this a suspicious pattern? Does this look like money laundering? In the legacy system, these checks are often manual or semi-automated, but require human intervention if a flag is raised. As we discussed in episode 986 about the hidden plumbing of money laundering, these delays are actually a feature for the regulators. They want the ability to freeze a transaction before it reaches its destination. If the money moves instantly and with finality, the regulator has no time to step in and say, wait a minute.
That is a really important point. In the crypto world, once a transaction is confirmed on the blockchain, it is generally considered final. You cannot call up the Bitcoin network and say, wait, I made a mistake, please reverse that. But in the banking world, that 3-day window provides a safety net for fraud prevention and error correction. If someone steals your checkbook and writes a fake check, the bank can often stop that payment because the settlement has not actually happened yet. The friction is the security guard.
You are touching on the settlement risk versus operational safety trade-off. In the traditional world, we trade speed for the ability to reverse errors and catch bad actors. In the crypto world, we trade reversibility for speed and finality. But here is the kicker, corn. Is crypto actually as instant as people think it is? Or are we just comparing a fast car to a slow bus without looking at the traffic lights?
That is where it gets interesting, right? Because if I send you Bitcoin, it might show up in your wallet in seconds as unconfirmed. But most exchanges or merchants will tell you to wait for 3 or 6 confirmations before they let you spend it. That could take 30 minutes to an hour. So it is faster than a 3-day ACH, but it is not exactly the blink of an eye that the marketing suggests. It is what people call probabilistic finality.
With every new block added to the chain, the chance of that transaction being reversed or reorganized out of existence drops closer and closer to zero. But it is never technically zero in the same way a centralized ledger is. However, the architecture is fundamentally different because it is a broadcast model. Instead of me telling my bank, who tells a clearinghouse, who tells your bank, I just shout my transaction to the entire network at once. Everyone updates their copy of the ledger simultaneously. No reconciliation needed because there is only one ledger that everyone agrees on.
So, looking at those two models, The question Daniel posed is, what can the old school banks learn from this? If they want to get rid of that 3-day lag without losing the ability to fight fraud, what does that look like? I have been hearing a lot about FedNow lately. We are 3 years into its rollout now in 2026. Is that the answer?
FedNow is a massive step. It launched back in 2023, and it is essentially the Federal Reserve's attempt to bring the United States into the world of real-time gross settlement for everyone, not just big banks. The goal is 24/7, 365-day-a-year instant transfers. No more business days only. No more Friday afternoon black holes. It is basically trying to make every transaction a wire, but at the cost of an ACH.
Okay, but if it is still a centralized system, how are they making it instant, without the liquidity risks we talked about earlier? If Bank A sends money to Bank B at 2 a.m. on a Sunday, does the Fed have to be awake to settle it?
They are essentially automating the wire process and making it accessible for smaller amounts. But they are also looking at things like tokenization. This is where the banking world is really starting to steal from crypto architecture. Imagine if, instead of sending a message saying, I owe you $50, the bank sent a digital token that actually represents that $50.
Like a stablecoin, basically. But instead of being issued by some company in the Caymans, it is issued by JP Morgan or the Fed itself.
But a bank-issued stablecoin or a central bank digital currency, a CBDC, if the asset itself is digital and atomic, meaning the transfer of the asset and the settlement of the transaction happen at the exact same moment, you eliminate the need for back-end reconciliation. You do not need to sit down at the end of the day and net out the differences because the value moved instantly. This is what we call atomic settlement. It is the holy grail of financial plumbing.
I love that term, atomic settlement. It sounds very high-tech, but it is really just going back to the way physical cash works. If I hand you a $5 bill, the payment and the settlement happen at the same time. There is no pending period where I might take the bill back. The challenge has always been doing that digitally, without a double spend problem.
And that is what the blockchain solved. It gave us a way to have digital cash without a central party. Now, the banks are saying, okay, we like the digital cash part, but we still want to be the central party. They want the efficiency of the blockchain's broadcast and atomic nature, but they want to keep the regulatory gatekeeper role. They want to be able to see who is sending what and freeze it if necessary. They are trying to build a walled garden version of crypto.
It is a bit of a have your cake and eat it too situation for the banks. They want the speed of crypto, but the control of the legacy system. But honestly, as a consumer, if I can send money to a contractor on a Sunday evening and have it land in his account instantly so he can buy materials Monday morning, I do not really care if the back end is a distributed ledger or just a really fast centralized database. I just want the plumbing to work.
That is the pragmatic view, and I think it is where the industry is heading. But there is a deeper architectural friction that we have not touched on yet, and that is the legacy stack. Most of these big banks are running on software that was written in COBOL in the 1970s or 80s. These systems were designed for batching. They were built to process a big pile of data overnight when the bank was closed. Trying to turn that into a real-time 24/7 system is like trying to turn a cruise ship into a fleet of jet skis. It is not just about the plumbing between banks, it is about the plumbing inside the bank itself.
That explains why some of the newer fintech apps feel so much faster, even though they are still technically using the old banking system. They are essentially faking the speed for the user. When you send money on a modern app, the app just shows you a success screen immediately. They might even front you the money. But behind the scenes, the actual settlement between the app's bank and your friend's bank is still taking 3 days. They're just taking on the settlement risk themselves to give you a better user experience.
That is a brilliant point, Korn. A lot of what we perceive as innovation in finance right now is actually just better risk masking. The apps are saying, we trust our users enough that we will pretend the money has moved, even though we know the ACH process is still grinding away in the background. But that only works for small amounts. When you are moving $100,000 for a house down payment, nobody wants to mask that risk. You want to know exactly where that money is. You want finality with a capital F.
This brings me back to something I have been thinking about regarding the global stage. We have been talking mostly about domestic transfers, but international transfers are where the legacy system really falls apart. You have the SWIFT network, which is basically just a messaging system. It does not even move money. It just sends a secure email saying, "Hey, Bank of Israel, please give Corn $50 and we will settle up later." That can take a week.
Oh, SWIFT is the ultimate example of architectural friction. It is a network of correspondent banks. If I want to send money to a small bank in, say, Thailand, my bank might not have a direct relationship with them. So my bank sends it to a big hub bank in New York, who sends it to a hub bank in Tokyo, who finally sends it to the bank in Thailand. Every single one of those hops takes time, involves a fee, and requires a separate KYC check. It is like trying to fly from Jerusalem to New York, but having to change planes in 10 different cities. Each city wants to search your bags and take a cut of your ticket price.
And this is where crypto really shines. If I have a wallet and you have a wallet, I do not care where you are. The distance between us is zero. The network does not see borders, it just sees addresses.
Right. And that is the efficiency that the traditional world is most desperate to adopt. There is a project called mBridge that involves several central banks, including those in China, Thailand, and the United Arab Emirates. They are building a shared multi-sig BDC platform where they can settle international trades in seconds using a common ledger. It bypasses the whole correspondent banking mess entirely. It is basically a private blockchain for central banks to settle with each other.
That sounds like a massive geopolitical shift, too. If you move away from the hub and spoke model where everything goes through New York and the US dollar, you are changing the power dynamics of global finance. If the plumbing changes, the power changes.
And being pro-American and pro-Israel, we have to look at that with a critical eye. The current system, for all its flaws and slowness, gives the United States a lot of financial soft power. If we can see and regulate the plumbing, we can stop terrorists and rogue states from moving money. As we discussed in episode 518, the central banks are essentially the economic thermostat of the world. If you move to a decentralized or fragmented instant settlement system, you might lose some of that oversight. The slowness is a surveillance tool.
So the slowness is not just about old computers, it is about sovereignty and security. We want the money to move fast enough to be convenient, but slow enough to be governable. That is a really tough needle to thread. It is like trying to build a car that is fast enough to win a race, but slow enough for the police to catch it if it breaks the law.
It really is. But I think the efficiency we can adopt from crypto without going full crypto is this idea of programmable money. In the legacy system, a payment is just a transfer of value. It is a dumb pipe. But in the crypto world, you have smart contracts. You can say, release this payment only when the shipping company confirms the package has been delivered, or pay this person $10 every hour they are clocked in.
That is where the real aha moment is for me. If we can make the plumbing of the banking system programmable, we solve the trust issue that causes a lot of the delays. Right now, a lot of the T+2 or T+3 delay is because both parties are waiting to make sure the other side held up their end of the bargain. If the contract is atomic and self-executing, the delay vanishes because the risk vanishes. The code is the escrow.
You are cutting out the escrow middleman. You are cutting out the verification middleman. You are letting the code handle the if-then logic of the transaction. Imagine a world where your employer's payroll system is linked to your time card, and you get paid literally as you work, second by second, with the taxes and Social Security automatically streamed to the government in real time. No more payday, just a constant income stream.
That would fundamentally change how people think about their finances. No more waiting for a paycheck to clear so you can pay rent. No more overdraft fees because of a timing mismatch between a deposit and a withdrawal. It would smooth out the volatility of personal cash flow. It is like moving from a world of buckets to a world of pipes.
It would, but it also requires a level of always-on liquidity that most banks are not prepared for yet. If money is constantly streaming out, the bank needs to have a constant stream of money coming in or a massive buffer. Our current system is built on lumpy cash flows. We get paid once or twice a month, we pay rent once a month. The banks love that because it makes their job predictable. They know when the big waves are coming. Streaming money is like a constant tide.
So, we are looking at a future where the friction is being sanded down from two directions. You have the bottom-up pressure from crypto and fintech apps making us demand more speed. And you have the top-down pressure from central banks like the Fed and the Bank of Israel trying to modernize the core plumbing with things like FedNow and CBDCs.
And I think the middle ground is going to be tokenized deposits. This is a concept where your actual bank balance is represented by tokens on a private, bank-run blockchain. When you pay someone, you are just moving those tokens. It looks like a normal bank account to you. It has the same FDIC insurance and regulatory protections, but on the back end, it moves with the speed and atomicity of a stablecoin. It is the best of both worlds.
That seems like the most likely path forward. It keeps the trust of the banking system but uses the architecture of the distributed ledger. But I have to ask, Herman, is there a downside to instant everything? We mentioned fraud prevention, but what about just human error? I've definitely sent an email to the wrong person before. If I send my entire life savings to the wrong token address and it settles atomically in 1 second, I am ruined. There is no unsend button in an atomic world.
That is the undo button problem. In the legacy system, friction is a safety feature. It gives you time to realize you made a mistake and call the bank to stop payment. In an instant world, we need to build new types of safety valves. Maybe that looks like a multi-signature requirement for large amounts or a smart contract that holds the money in purgatory for an hour unless both parties bypass it. We have to build artificial friction to replace the natural friction we just removed.
It is funny. We spend all this time trying to get rid of friction, and then we realize we have to reinvent it in a different way to keep ourselves safe. It is like how cars got faster and faster, and then we realized we needed to invent seatbelts and airbags. The faster you go, the more the mistakes hurt.
That is a perfect analogy. The slowness of the current banking system is like a very old, very heavy car that cannot go over 20 miles per hour. You do not really need a seatbelt because if you hit something, you are probably fine. But as we move toward the Ferrari of instant, programmable, atomic finance, we better make sure our financial seatbelts are top-notch. We need better digital literacy and better interface design to prevent those, oops, I sent my house to a stranger moments.
So, for the listeners who are frustrated with their pending transactions today, what is the practical takeaway? Are things actually getting better, or are we just going to be masking the slowness with better apps for the next decade?
I think we are at a genuine inflection point. The launch of FedNow was a massive opening of the gates in the US. You are going to start seeing more and more banks offer instant transfers as a standard feature, not an extra fee wire. My advice to listeners is to look for real-time payment or RTP logos on their banking apps. If your bank is not moving toward these instant rails by now in 2026, they are effectively falling behind the curve. They are the ones still using the carrier pigeons.
And also, be aware of the reversibility trade-off. If you are using an instant rail like Zelle or a crypto transfer, you have to treat it like digital cash. Once it is gone, it is gone. If someone calls you claiming to be from the bank and asks you to instantly move money to a safe account, that is a huge red flag. The faster the money moves, the faster the scammers can disappear with it. The 3-day hold was your friend in that scenario.
Precisely. The friction in the old system was a barrier to efficiency, but it was also a barrier to instant theft. As we remove the barrier to efficiency, we have to become more vigilant as individuals. We are moving from a world where the system protects us through its own slowness to a world where we have to protect ourselves through digital literacy. It is a trade-off of convenience for responsibility.
That is a powerful shift. It is almost like a maturation of the financial user. We are getting more power, more speed, and more control. But that comes with more responsibility. I think about how my grandfather used to go to the bank once a week, talk to a teller he knew by name, and get a physical passbook updated. There was zero speed, but a lot of human friction that provided security. Now, I can move thousands of dollars while sitting on my couch in my pajamas at 2 a.m. The human element is gone, replaced by code.
It is incredible when you think about it. And honestly, despite the frustrations, we are living through a golden age of financial innovation. The fact that we can even have a debate about whether 3 days is too long to move money shows how far we have come. For most of human history, moving money meant putting gold on a ship and hoping it did not sink or get captured by pirates. We have traded pirates for pending screens. I think we got the better deal.
Fair point. A pending screen is a lot better than a shipwreck notification, but I do think the crypto efficiency we should all be rooting for is that programmable money aspect. The idea that money can have intelligence built into it. Knowing when to pay taxes, when to release an escrow, when to trigger an insurance payout. That is the real future of finance that goes beyond just fast numbers. It is about making the economy itself more efficient, not just the transfers.
I agree. And I think the conservative approach to this, which we tend to favor, is one of ordered innovation. We want the speed, but we do not want to break the plumbing and cause a systemic collapse. We want a system that is pro-growth and pro-efficiency, but also one that respects the rule of law and sovereignty. The distributed ledger technology is a tool, not a religion. If we can use that tool to make the boring parts of banking like reconciliation and clearing happen in the background instantly, then we have succeeded. We have modernized the engine without crashing the car.
Well, I think we have thoroughly deconstructed the black hole of banking today. From the netting of ACH to the atomic settlement of the future, it is clear that the slowness is a mix of legacy technology, risk management, and regulatory policing. But the Ferrari of finance is being built, one tokenized deposit at a time. It is a slow process to make things fast, which is its own kind of irony.
It really is. And I want to thank Daniel for sending in that prompt. It is one of those things we use every day but rarely stop to think about the why behind the pending sign. It is the invisible architecture of our lives. If you are listening and you have a weird prompt or a question about the hidden systems that run our world, please get in touch with us. We love digging into the plumbing.
You can find us at myweirdprompts.com. We have a contact form there. And you can also find our full RSS feed and all 1009 episodes in our archive. If you have been enjoying our deep dives into the plumbing of the world, we would really appreciate it if you could leave us a review on Spotify or whatever podcast app you're using. It genuinely helps other curious people find the show. We are trying to grow this community of nerds, one review at a time.
It really does make a huge difference. We love seeing the community grow and hearing your theories. And if you want to dig deeper into the regulatory side of what we talked about today, definitely go back and check out episode 9085 on the history of KYC. It provides a lot of the political context for why the plumbing is designed to be so nosy. It is not just about the math, it is about the policy.
Great recommendation. All right, Herman, I think I'm going to go check my bank account and see if that transfer from last Tuesday has finally cleared. Maybe by the time we record episode 1010, it will be final. I can dream, right?
Don't hold your breath, Corn. At least, not until your bank joins the atomic age. Until then, you are still riding the bus.
Fair enough. Thanks for listening to my weird prompts. We will be back soon with another exploration of the strange, the technical, and the overlooked.
This has been My Weird Props. See you next time.
This episode was generated using Gemini Flash 3. Text-to-speech engine was Chatterbox.
Thanks for listening to our show, My Weird Prompts, where our thoughts go from slow takes to facts on cue. We change and follow through. My weird prompts.